RBA leaves cash rate on hold in February. The Reserve Bank has left the official cash rate on hold at 1.5% in its first meeting of 2017, and the majority of experts now believe the next move will be up. The RBA was widely expected to keep rates on hold at its February meeting after cutting rates twice last year, first in May to 1.75% and then in August to its current historic low. The last time the official cash rate increased was November 2010. According to a survey of 32 experts and economists by comparison website finder.com.au, 58% now believe the cash rate has hit its lowest point this cycle. In the past few months, there's been an increasing sentiment towards a cash rate lift, Finder.com.au Insights manager Graham Cook said. But don't hold your breath as the upward move is potentially months away. Mr. Cook added that 77% of experts believe Australia has an oversupply of apartments, with Melbourne facing the biggest glut. But AMP Capital chief economist Shane Oliver believes there is still room for further rate cuts. He said while the low September quarter inflation reading had left the door wide open for a rate cut today, the inflation outcome was in line with the RBA's own forecast. He said the RBA would also want to monitor the recent increase in lending to property investors and further data about the economy's performance after the September quarter slump. As a result, all eyes will be on the post-meeting statement and the statement on monetary policy to be released Friday, Dr. Oliver wrote in a client note. Our assessment remains that, with record low wages growth, ongoing spare capacity, and increasing risk that low inflation will feed on itself, and the dollar remaining too high, the RBA will cut rates again around May. Also of interest will be what the RBA has to say about the research in Sydney and Melbourne property markets. Are they embarking on another round of discussions with the CoreLogic head of research Tim Lawless said the whole decision was widely anticipated considering the strength in the housing market as last year's rate cuts spurred investor activity. With inflation consistently tracking below the RBA's target range for almost 3 years, it's likely that the heat in the housing market is one of the primary reasons why the cash rate hasn't moved lower in an attempt to stimulate spending and push inflation higher, he said.